Hello, welcome to Asset TV Fund Fit. My name is Zamazulu Zulu. For today's session, we are going to be having a discussion about the Flagship Worldwide Flexible Fund. And in the studio, I'm joined by firstly Philip Short, who is the portfolio manager of the fund. He's from Flagship Asset Management. And to his right, we've got Megan Bellinger, who is a research investment analyst at Analytics Consulting. And then we've got Bradfield, who is from Sharenet Wealth. Welcome, lady and gents. It's nice to see you. All right, so Philip, let's start off with you. It's a worldwide flexible portfolio, which means you can have either 100% local or 100% offshore. How do you go about deciding how much of each you should have in the fund? Just to kind of give us a sense of your thinking when you start doing the portfolio composition.
Yeah, so our first priority, our main goal at Flagship is how we think about this is we first want to protect the client's capital, and thereafter we're looking to generate inflation-beating returns. When doing so, we try to utilize an active risk management framework or process which lets our winners run for longer and we cut our losses shorter. And our decision making is very disciplined. But before we get to that decision-making process, we follow an unconstrained approach. And what I mean by that is that we style agnostic, so we embrace all styles, quality, value, and growth. We utilize both top-down and bottom-up analysis. And we don't look at just emerging markets or just developed markets, we look globally. So, so we're not limited and we don't constrain ourselves to where we look for the best opportunities globally. And then with our philosophy and process, we select those that we think can generate those returns.
All right, okay, no, thanks for that. I think that makes a lot of sense. Megan, let me bring you into the conversation now. So from a DFM perspective, from my experience, I usually find that most DFMs typically prefer to manage their own asset allocation in a fund. So with this particular fund of Flagships, where they are taking care of that allocation between asset classes as well as between the geographical element, how does this fit in your portfolio construction process?
Thanks, Sama. Well, first of all, the Worldwide Flexible category is great in terms of it's a go anywhere kind of category where you're going to find a wide variety of different types of funds. So it's very important to understand the structure of their funds. So as Philip has indicated, the way they go about deciding on where to allocate, it's all important to incorporate that into your investment decision making for the overall portfolio solution that you're trying to build. So for example, with Flagship being equity centric as well as quite diversified across a lot of other asset classes, that's an important element to consider because essentially you, as you alluded to, you are outsourcing a lot of the important decision making steps such as asset allocation, potentially currency decisions, the split between local and global exposure, as well as the tactical moves. So when you do have an unconstrained kind of mandate such as this, it does increase the complexity when building an overall client solution, but it's also great because you are in essence getting the investment manager's best investment ideas and views into one fund that should hopefully be appropriate for the end solution.
So where does this fit? So would you incorporate this particular portfolio as part of the global piece, or I'm just trying to understand when you are constructing your model portfolios, for example, where would this fund fit in?
So Zama, that really depends on the end solution that we are building, and that can vary as well. So if it is going to be used in a client financial planning solution, obviously that is not Regulation 28 constrained, and the client wants to use it as a kind of an add-on to the local component, we're going to look for the worldwide flexible funds that have a global asset bias, for example. So it all depends on that end solution and making sure that the objective of that solution is aligned with that of the worldwide flexible structure and objective of its own.
All right, okay, thanks for clarifying that. That makes a lot of sense. All right, Dylan, let me come to you. So from your perspective, what type of client would this strategy be suitable for?
So we incorporate quite a few different high net worth clients along the spectrum. Most of them have already taken the route of externalizing lots of their money. For those that are quite like SA centric, that have been sort of patriotic to the SA market, that are now a little bit more information savvy about what's out there and what potential for growth in global markets. Those type of individuals that are in a spectrum where they're looking for a little bit more, they are going to be retired in South Africa. They're not looking to use their money from an externalized basis. They just want to get the growth offshore. They want to be able to match their lifestyle, as Phil alluded to earlier. They are focused on an inflation-beating type of return. For many years, looking back, some of the performance in the local markets have been waning. So, to those type of individuals that are a bit more open-minded to the growth dynamics of broader markets, those are the type of clients we're trying to move towards. We're trying to motivate the broader thinking of diversification across the waters, letting the manager understand all of the risk premiums that come with it and diversification. So, yeah, effectively, that's how we would sort of pitch it to our clients.
All right, okay, that makes a lot of sense. All right, so then let's move on to the next topic, risk management. So you'd already mentioned it as part of your opening statement, Philip. So firstly, you did mention this is an equity-centric portfolio. So I think anyone who's investing in it should expect higher volatility purely based on that nature of that equity centricity. But do you utilize any hedging strategies? I'm just thinking even from a currency perspective, how do you go about managing the downside in this particular portfolio?
Usually, while we don't take any hedging exposure, we're not against it, but we find that up to now, buying the underlying and being nimble and being able to act quickly, we can get in and out of positions where we need to. So, but risk management, I would say, is our primary and most important tool that we have in our investor toolbox.
And then, Megan, from your perspective, how important is this risk management piece for you as a DFM looking at this type of portfolio?
It's absolutely one of the key considerations. So just as you would expect the if I say normal considerations to look at when you look at for a manager, such as their experience and track record over a meaningful time period, a very clear articulated investment philosophy that we can understand, and a robust process, risk management goes hand in hand with that. And just as you would love unlimited upside for performance, we know that doesn't happen in real life. So the risk management is just as crucial. And it's a bit of a two-pronged approach because it can come in the form of investment risk management. So in terms of what we alluded to now, potentially hedging or being nimble to move, etc., as well as the operational and trading side of risk management. So we want a manager to be able to demonstrate to us that they have a sound system in place.
Okay, no, that sounds good. And then Dylan, from your perspective, when you are positioning this type of portfolio with the high net worth individuals that you mentioned earlier, are they comfortable with the additional volatility that this type of strategy would typically bring in?
Yes, I think, with any conversation, we started with the idea that it's more about the manager than the mandate, so that they can understand that, what you are investing in is a professional that can have a look through, has navigated volatility in markets before, and you are going for risk-adjusted returns. So, your environment to which you can invest in it's immense. So, you are opening yourself up to higher returns. You are probably opening yourself up to more volatility along the way. But I think with any experienced fund manager, they take advantage of that volatility to capture those outsized returns.
Yeah, and I'd say, that's a good point that Dylan made, is that when we, for example, look at a global equity fund, I think, time in the market shows that the longer you're invested in the market, you're going to do better on an absolute basis in a fully invested equity fund. What we see and what we pitch flexible funds as is the best risk-adjusted return type of investment vehicle. So, being able to move quickly between equities and bonds, they usually 90% of the time they're not correlated, so you can get that relationship of when the one's not doing well whilst the other one is doing well. And when you're realizing, as we saw in 2022, that they were positively correlated, and then you can move into something like into commodities, into gold, and into cash. So the flexibility is there to be able to move across all asset classes and not waiting for the initial investor to get the monthly report at the end of the month and say, okay, my equities aren't doing too well, maybe I should move to fixed income. and then the CGV event is taking place at the investor level, where it's not taking place within the fund or the flexible fund level, which is another advantage we see.
Yeah, and I must say that CGT event that you refer to is actually a serious reality, I think, for a lot of individual investors. What I forgot to ask you, Philip, earlier are ESG considerations. Is that a factor that plays in how you select your stocks for the fund? Is that something that you think about?
It is, but I must say our primary driver is returns for the clients. Obviously, we're not going to be investing in something where there's an explicit detrimental ESG effect, but I think the waters have been muddied quite a bit in terms of what is ESG, and I think if you really push the limit, you'd be invested in nothing.
Yeah, and I suppose that is the reality. So maybe just to summarize your strategy in general, you're aiming to generate equity type returns at significantly less risk. Have I summarized it correctly, or are there other bits to add on to that?
No, there's other bits to add to that. We generate inflation beating returns. That's our aim. Because when equities aren't doing well, the clients don't want to hear, okay, but we beat equities even though we made a minus 20% return. So we want to be through the cycle, inflation plus type of returns. And then we are very, very focused on risk management. And where that stems from, the idea is that we appreciate that we do not know everything, and we also know that we are going to make errors. So with the risk management process that we have, when we make losses, we want to make them small, and when we make profits, we want those to be big. So it's about, as I said earlier, about letting your winners run and cutting your losses quicker.
All right, let's talk about the portfolio positioning at the moment. So when I looked at the end of September numbers, you roughly had about just under 90% of the fund allocated to equities. Out of interest, because you've got this flexibility in the mandate of the portfolio, what is the lowest equity holding you've had in the fund since inception?
0% in H2 2008.
So you actually use that flexibility. That's incredible.
That's what we get paid for. We have to do that, and we hope that we get it more right than wrong. And then in those extreme cases, that comes with higher conviction. So we look at a probabilistic outcome in terms of our decision making. The higher conviction, the bigger the position. At that point in time, they had the conviction to move to a 0% position before the crash, that at least the significant part of the crash had happened in 2000.
And where was the balance of the portfolio?
Cash.
Was it cash, pure cash? Okay.
Yeah.
All right, because that was going to be my next question. I mean, how comfortable are you in utilizing cash? So clearly very comfortable based on the historical experience.
Yes, and I think if you look at US cash at the moment, you can get 4% in sort of very short-term duration. So that's very low duration risk in those returns, and you're getting about 4% in US dollar cash. So you're not far off from beating an SA inflation plus just holding at that. But that is, I can't remember when last we had 4% US dollar cash returns. So we're not afraid to hold that cash now. So for example, if you're looking at US 10-year, we don't hold any bonds at the moment. Bonds which are now 10-year bonds which are giving you 4.3%. We see downside risk or upside risk in terms of yields, but downside in terms of pricing. In terms of supply of US debt that's coming to the market with the deficits and the debt that they're busy running, as well as inflationary risk that we might be getting now also with the spending. So you're getting 4% on 10-year bonds, you're getting 4% in US dollar cash, and we think that there's downside in terms of pricing for US dollar bonds.
Okay. I was actually going to ask you about the US because I see that's the bulk of the allocation, geographical allocation in your portfolio. Just any thoughts? I know we don't really like having conversations around, outcomes of binary events. Next week we've got a major election taking place on the 5th of November, Guy Fawkes Day. There's going to be fireworks, without a doubt,
yes,
on that day. Any thoughts on that? Are you maybe making any tactical changes in your portfolio leading up to the US elections?
The one is bonds, and having 0% in bonds at the moment.
Okay, all right. The one surprise for me that I didn't really expect from your top 10 holdings, just looking at the stocks that you've got, was seeing Blue Label,
yes,
telecoms, as your top holding.
Yes.
Maybe just you can quickly just share what is the investment case for that particular stock?
So generally we wouldn't, in the worldwide fund, we wouldn't have more than 5% in SA. We've now got 22-25%, where we took 20% just before the SA elections as a tactical positioning. In Blue Label, in my old analyst days, I was a telco analyst here in South Africa, so very close to the stock. We did buy that stock at lows in September last year, and it's up 100% since then. So, and it has done very, very well for us, even in dollar terms.
Okay, all right. And then the gold position, I thought that was
Yes.
also an interesting one. I suppose it's a great uncorrelated asset class.
Yes, more so nowadays. So we also held that for a while. When the US decided not to pay Russia when they froze their assets after the Ukrainian invasion, not only did they show that they were always able to pay their debts, but they showed at that point in time that they're not willing to pay their debt. So it's true that the US is not now the safe haven that it used to be. And we saw gold decouple from real rates on that day. So from then we held a lot of gold, 6-7% in the funds in gold bullion.
All right. I think the important part now of the conversation is to talk about the accessibility of this fund, because I think in this industry, you need to have your funds easily accessible for various participants in the market to access them. What is your platform availability like on the various lists? Are you available? Is the fund available everywhere?
We are on 91, Momentum, Glacier, and Old Mutual. So most of them.
Most of them. Okay, no, that's great, because I'm just thinking for the likes of the DFMs and wealth managers, it's important for them to be able to access, especially if they like what they've heard from today's conversation. All right, great. And then just maybe in closing, Philip, why Flagship? What would you say differentiates Flagship asset management relative to peers? And why should our viewers watching this episode seriously consider the Flagship Worldwide Flexible Fund?
So when we started in 2001, we started with a global fund, and today our focus is still on global. So that's our DNA. I think if you look at the vast majority of our peers here in South Africa, they first started investing locally, and then later down their timeline, they invested globally. So that, I think, is one key differentiator. The second one is that we are patient investors, but we're not afraid to be nimble and act quickly and decisively. And then thirdly and finally, I think our risk management process, which we developed, was born out of two ideas. It is to remove the emotional biases that come with investment, and also to build in a sort of a loss limit of when you think that you could be wrong in the market, or to be able to admit that and have the humility to admit that and say, I'm wrong. You can look at your process, and your process says, yeah, you're wrong.
Okay. Fabulous. Any last words from you, Megan? Dylan, anything that you'd like to add from your perspective on this particular fund before we close off?
Yeah, I'd just like to say that I think there's always a space for the common big names that you're used to seeing every day, as well as the smaller, maybe boutique names you less know, and especially with the likes of Flagship, who you can clearly see from what Philip has said, although they have a very strong fundamental bottom-up process, they incorporate the macro quite heavily, and often you get the best of both worlds in that regard. So there's always a space for both, as long as it is appropriate in the overall client solution.
Okay, great. And you, Dylan?
She literally took most of the words out of my mouth in regards to what I would have said. Yeah, I just like the fact that Phil and the team, when they have conviction, they have conviction. When they need to go into cash, they go into cash. And for our clients, I think that's important.
Okay, fabulous. So that flexibility works for you.
100%.
Excellent. All right, well, I think we'll wrap it up there. Thank you, Philip Short.
Thanks, Owen.
Megan Bellinger. And Dylan Bradfield.
Thank you.
Thank you so much for your time. And thank you to all our viewers for tuning in. Take care.